Law firm owners, there's a special kind of pain that only hits in April. It's when your CPA says, good news, you had a great year, and then shows you a tax bill that makes you want to throw up. Today's confession is about a firm that unknowingly gave the IRS a $34,181 tip and how we fixed it. Names and details are changed, but the numbers and the mistakes are very real. Picture a 3-attorney firm doing just under $900K a year. From the outside, they're killing it. New office, busy calendar, staff that's always running around. From the inside, the owner feels broke. He's paying himself something, but he can't ever tell you how much he actually takes home. The only number he knows for sure is whatever the CPA tells him to wire every quarter for taxes. One year, he gets hit with a tax bill that's about $34,000 higher than he expected. He calls the CPA. Is this right? CPA says, yeah, that's just your tax rate with the income you had. Great problem to have. That's when he came to me. Not because he understood what was wrong, but because he was tired of feeling like everyone got paid except him. When we did the review, 3 things jumped out immediately. First, the books were technically done, but not designed for tax planning. Everything was lumped into big, lazy categories. Office expenses, miscellaneous, owner draw. No detail, no separation between truly personal stuff and legitimate business expenses he was scared to categorize. Second, he was paying himself in the least efficient way possible. Huge, inconsistent wages to himself, payroll taxes on money that didn't need to be on payroll, and then random extra draws on top. No rhyme or reason, just there's cash in the account, let's pull some. Third, nobody was actually looking ahead. The CPA was doing exactly what he was hired to do. Take the books as is, plug them into the return, and make sure it was legal. Nobody was saying, hey, if we classify this correctly, structure your comp sanely, and plan before December, we can change what you owe. So we went line by line. We cleaned up the chart of accounts so the firm's real costs were obvious. We moved a bunch of legitimate, clearly documented business expenses that had been left personal just to be safe. We put his owner pay on a simple, stable structure his CPA was comfortable signing off on. Then the CPA reran the numbers. The difference for that year alone was the $34,181 in overpaid tax. That's not magic. That's what happens when 1, the books tell the truth, 2, the tax pro has clean data, and 3, someone is actually asking, how do we keep more of what you make, instead of just reporting what happened? Here's the part I want you to take away. This firm didn't get in trouble because of fraud. They got punished for sloppy bookkeeping and zero planning. If you're listening and you don't know your real take home, your books are a generic QuickBooks mess, and the only time you think about taxes is when your CPA emails you an amount to pay, you might be tipping the IRS every single year and not even know it. Later in this episode, I'll walk you through the 3 questions I use to spot that IRS tip in a law firm's books and what to fix first if you want to keep more of your own money. And if you want me to run that same review on your firm, that's exactly what I do in our Trust in Books checkup.
Mailbag.
Welcome to the Big Bird Mailbag, where I answer real questions from law firm owners about their books, their trust accounts, and saving on taxes. If you have a question you want to answer on the show, leave a comment and I will work it in. All right, question number 1. Jen from Wichita asks, Chris, my firm did around $500K last year. Some months I pay myself a lot. Some months I take almost nothing. My CPA says whatever's left is yours, but that doesn't feel like a plan. Is there a simple way to know how much I should be paying myself as the owner? Yes. There are some simple rules of thumb that I would incorporate into your business that are going to make it simple. It does depend, though, on whether or not you are taxed as a sole proprietor, like an LLC, or if you have elected an S-Corp status. It's going to change the answer slightly. Step 1, though, is I would figure out, what are your monthly living expenses? That's what I would take out as a regular draw, sort of like every month. Okay? If you are not taxed as an S-Corp, you would just pull that out maybe whenever you want, on the 15th, and the 30th. However you would want to do your pay schedule, I would just put it on a regular schedule and then I would make it happen. So if you need $20K a month, I would take $10K out on the 15th. I would take $10K out on the 20th. If you are not being taxed as an S-Corp, you're going to have to remember that some of that's going to go towards taxes at the end of the year, which is a separate question that I think we'll maybe answer now, or we'll answer it later. But this is just about pay. If you're being taxed as an S-Corp, I would do the same thing, except you're going to want to think about what you need to pay yourself to meet the qualifications for a reasonable salary. That is the maximum that I would run through payroll on that schedule. The rest I would take as a draw. So if you need a $20K and it's reasonable to pay $10K a month to an attorney doing similar work, I would do $10K on the payroll, and then I would take a $10K draw every month. Then what I would do is every quarter, I would see, hopefully I have clean books and you have quarterly reports. You can see what the profit is from that quarter. And if you want to take a bigger draw at that quarter and use that money to invest or to do whatever you want, then that's what I would do. So step one is to think about what you need to get paid every month. Take that out regularly. And then on a quarterly or maybe even semi-annual basis, you'll take a bigger bonus based on what the profit is through the firm. So that's what I would do. Okay, great. All right, number two, Rich from Spokane asks, be honest, is the separate tax account thing actually necessary? Right now, everything runs through operating, and when my CPA gives me a number, I just send it. It feels like one more account to manage. What do you tell law firm owners to do here? I will tell you what I tell law firm owners to do, and I will tell you what I do as well, which is I have this separate tax account. Here's why. First, it just makes it easier. You don't see the money. The money just goes off into the universe, sits in that account, and it's ready for you when you need to write that check. It doesn't feel like money that is yours. So paying those taxes don't feel like you're losing money. It doesn't feel as emotionally, damaging when you do that. And it also builds up a nice little nest egg, a nice little safety net in case you need money for something else, to be honest. I always thought of it both as my tax payment plan and as my emergency fund throughout the year. So if something just drastic happened, I just had some extra cash. What I would do is every month I would see what my profit is, and I would take 20%, 10 to 20%, and I would drop it into this tax account. If you're an S corp and you're paying yourself a salary, that percentage can be a little bit smaller because as you take this salary, you're going to be paying some taxes through the payroll when you pay payroll. So that's what I would do. But yes, I have a separate tax account I have for years and years and years. It's never let me down. It's like autopilot. It's only one transfer a month that you need to make, and it will make you feel really great. Okay. All right. Perfect. All right. Last question. Bruce from Dallas asks, I like my CPA personally, but all we ever do is file last year's stuff. No planning, no proactive ideas. At what point do you tell someone you've outgrown this CPA? And what should I be looking for in a new one? Great question. I'm not going to answer it the way that you think. I'm pretty sure. Number one, the CPA that's doing your taxes is probably doing their job perfectly well. You probably should just keep them. So I wouldn't think about it as getting a new CPA. I would think about it as adding a new expert in sort of your panel of experts that help you out. So you need to have a good bookkeeper, the bookkeeper that's supplying you with clean books on time, clean IOLTA reports, the type of stuff that we do. And then a lot of times you can find a bookkeeper that will also provide you with, quarterly tax strategy or be available to answer tax questions. That's also what we do. Not all bookkeepers do that. So if you right now have a good CPA and you have a good bookkeeper, then you would probably want to look for someone that can give you some strategic tax advice, like on a quarterly basis. You're going to pay them a little bit of a fee. You will show them your P&L, year to date. You probably show them your tax return from last year, and they will be able to give you some ideas to help you save on taxes. Your CPAs are designed and really, really good at filing and filling out the forms at tax time. It's really, really confusing and it sucks. Okay, I've done it. I hate it. That's why we don't do it, because there are people that love to do it and they are really good at it. So let your CPA complete and file your taxes properly, and then find someone else who really enjoys keeping books clean, analyzing business, talking about tax strategy, and utilize that person for that role. So the only reason I really would get rid of your CPA in this scenario is if they are not doing quality work, if they are not responsive, if they're just not providing you a good service, I would do that. But bookkeeping and tax strategy are typically not part of your CPA's service bundle. All right. That is it for tax time. Hopefully this helped. Hopefully it made sense. If it did, that's great. And if you want some help with your books, we do offer a free books and trust checkup. Go check it out. All right. That's the Big Bird mailbag for this week. Up next is everyone's favorite part of the show, Big Bird's Tax Corner, where we help you keep more money, keep more of what you earn by lowering your taxes. Cue the graphic. Welcome back to Big Bird's Tax Corner, where small law firm owners learn how to legally pay less in taxes without doing dumb stuff that gets you in trouble later. Today's topic, stop spending $1 to save 30 cents. Every year, around November and December, some version of this happens. A law firm owner calls their CPA and says, I don't want to pay so much in taxes. What should I buy? And the CPA suggests, because it's just low-hanging fruit, something like, well, If you bought a $100,000 SUV, you could write most of that off this year. Here's the math nobody says out loud though. First, you're going to spend $100K. Let's say your combined tax rate is 30%. You will save $30,000 in taxes when you depreciate that vehicle, which you can do. But in reality, you're going to save that $30,000, but you're still going to be out of pocket $70,000. $70,000 poorer than if you just had paid the $30K in tax and kept $70K in your pocket. The goal here, at least for me, is more after-tax cash, not a smaller tax bill at all costs. Write-offs are a discount. They're not free money. So before you make a tax move, run it through these questions. First, would I buy this anyway if there were no tax benefit? If the honest answer is no, you're not tax planning, you're rationalizing a purchase. Number two, does this increase my firm's earning power in the next 12 to 24 months? A good hire, better software, or marketing that you know how to use that can pass these tests. How are you going to make more money, basically? Okay. And number three, what's my after-tax position either way? Okay, compare spending X and maybe saving 30% of X in taxes, keeping the rest in an asset that you don't actually want, like a big old SUV, okay? Versus you don't spend the money, you pay the tax, and you keep the remainder in your bank account. So you can invest it, you can put it back in your business, you can do all these kinds of things. If spending doesn't clearly leave you with more net worth, it's not a smart tax move. It's just expensive. And once again, you can't even have this conversation honestly if your books are a mess. If you don't know your real profit, your cash, and what you've already spent, you're taking tax advice on fantasy numbers. That's why in the Trust in Books checkup, we start with, are your numbers even trustworthy enough to plan from? And then we talk about how to keep more of what you make before you start shopping for write-offs. That's it for the Tax Corner for today. See you again next week. Real quick, if you're a law firm owner doing between $300K and $1 million a year, and you're not confident your books and trust account would survive an audit, I'm offering a free Trust in Books checkup for your firm. We'll review your setup, flag any real risks, and outline a cleanup plan. To book yours, go to bigbirdaccounting.com/checkup.